Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning. He is president and founder of McIntire Retirement Services. Chris McIntire here with us, addressing the complicated issues with our money, our investments, and our retirement plans. Chris, always a pleasure. We appreciate you being here. And today, apropos for the St. Patrick's Day holiday, we are talking about luck versus planning and why too many of us are simply relying on luck for retirement.
Yeah, exactly, Peter. And, with the last name of McIntire, the luck of the Irish, and technically I think we're Scottish, but we'll call it closely related anyway.
Well, Chris, when it comes to luck, there are a lot of sayings. One being, if it wasn't for bad luck, I'd have no luck at all. Luck favors the well-prepared. I think that one is also appropriate for today's discussion. But the way that a lot of Americans sort of leave things up to chance, it's kind of like the Dirty Harry quote with luck. Do you feel lucky? Well, do you? Right? And we are really leaving it up to a lot of chance when we retire with the traditional investment Wall Street model. And I know you spend a lot of time at McIntire Retirement Services trying to drill down on what the risks are and then addressing them so that people are taking that element of luck off the table and planning more appropriately.
Yeah, you're correct there, Peter. And, I often like the cliche, luck is where preparation met opportunity. And, and so being prepared for retirement, having the opportunity to retire and putting a lot of those pieces together and looking at all of the pieces that you can put, your retirement puzzle, has a lot of different pieces and you can put it together a lot of different ways, right? And I don't know if I would say everybody's got to do it this way because, we got people listening today that may have a nice pension, and then a Social Security benefit. Well, we can set their retirement up differently. We can put their pieces together differently than we can somebody that doesn't have a pension. They've invested in 401ks. They've taken ups and downs with the stock market. And unfortunately, we've had a pretty good down period here since, call it 2022, into 2023 so far. And, what's that going to look like going forward? So what are the alternatives for, that's probably the more traditional retirement now than ever before, Peter, the 401k and the Social Security benefit. That's what we deal with now, not the pension, Social Security. And, oh, by the way, yeah, I did save some money also.
Yeah, and that stability that is lost with the pension and the streams of retirement income, Chris, that we don't need to generate from our personal assets and investments. That's really what provided an awful lot of stability to retirements of the previous generation and maybe still a lucky few of us in today's financial world. But by and large, you're right, the pensions have gone by the wayside and the burden of funding retirement now rests squarely on our own shoulders, and the responsibility of making sure the dollars that we've saved are there to provide for our needs in retirement is a matter of planning that we don't want to leave up to luck and chance. And that's why, ladies and gentlemen, Chris McIntire stresses the written retirement income plan, your game plan for retirement, and offers to put that together for listeners to the program, for viewers of the podcast. No cost, no obligation, your opportunity to get your plan in writing and address the risks in retirement. Pick up the phone, give McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194. If you'd like to take Chris McIntire up on the offer for that complimentary review, the retirement planning strategy session, and to get your written game plan for retirement. 800-886-1194. 800-886-1194. 1194, or you can visit McIntyreRetirementServices.com and be in touch that way. So, Chris, is it really better to be lucky than good? I would argue no, it's not, because there's plenty of stories of lottery winners or very high paid individuals that have maybe a short career or an end to that earning potential, and then they end up going broke. I think success is long-term behavior, pattern, routine, and it's much better to be good than lucky in our financial lives.
Yeah, and Peter, and you and I know a couple of folks in this industry as well that some health issues had stricken them, and it changed their plan. And some of them have had alternatives in place. That's where life insurance can come into place. But always being prepared for the unexpected. We're up here on the shore of Lake Erie, and so I'll say the Coast Guard's motto is Semper Paratus, which is Latin for always prepared, right? So they are prepared for the worst case scenario, and anything other than that makes life a little bit easier. And I think that's kind of what, when you work with people in that retirement time horizon, look, the margin of errors get shorter, and because they're not working, they're not living off of their income, their wages, they're living off of their investment. So we need to be very careful in, what's the risk approach, how are we structuring that lifetime income? How are we dealing with inflation? What do we do about healthcare issues? It could be somebody passing away early or spending a number of years in a nursing home. So a lot of different factors. And let's not forget taxation, as we're getting close to that April 15th deadline as well, right in the middle of tax season as well.
Yeah, Chris, just one or two mistakes or overlooking one or two risks or variables as we enter into retirement in the home stretch of our working career in the last few years, and especially in those early retirement years, really can be catastrophic for our trajectory and path forward. And unfortunately, some of them don't allow for mulligans or do-overs. We can't make up for some of those mistakes.
Yeah, you're exactly right. Mistakes can be very costly. And, if you think about like the law of large losses, if you lost 30% in the market, for example, you need to make 43% to get back to where you're whole. So, you want to be able to mitigate and strategize against that type of stock market risk, because it's unique. You and I see these figures all the time when we go to conferences and whatnot, and it's hard to convey over the radio. Some of you are watching us on a podcast here today, but when you see the figures that a well-balanced, diversified portfolio stands up better than a 100% stock portfolio when you're taking income out of it because of that law of large losses. I mean, most people would think, well, I got to be in stocks if I'm going to run this thing out for the long haul. So, well, maybe in the accumulation phase, but not in the distribution phase. You have to mitigate that loss potential, as an example.
Yeah, Chris, we've talked about the fact that the investment portfolio and the growth over time on that worked effectively, most importantly, because you were earning that paycheck, and that's what supported your ability to overcome periods of market volatility and downturns in the market. The paycheck is really the most important thing. And Chris, that fact doesn't change in retirement. So we should not leave our income up to luck and chance.
Yep, you're exactly right. We want to, structure that income so that we're covering at least the basic needs, the daily living expenses. Okay. Not necessarily, hey, we're going to take a once in a lifetime trip, but we want to cover, what do you need for maintenance, daily living, that type of thing. And have that coming from, contractually guaranteed places, Social Security, pensions, and then have the ability to increase that income as the cost of living increases as well. Because, inflation is certainly something that seems to be, maybe it's going to stick with us at a higher pace than what most of us have been used to for the last, let's call it 20 years, Peter.
Chris, what is the difference in experience between an individual or a couple, a situation where somebody had structured that well-balanced portfolio after a year like 2022, like the losses that we've seen, versus somebody who was maybe more aggressively invested in retirement?
Yeah, I got a great example. We're helping a client right now, and she had a fund with a different advisor, and in 2022, that particular growth fund lost 50% of its value.
Hmm.
And where if she'd have been in something that was probably a lot more designed around her or overall real risk tolerance, she would have been in something much more diversified and certainly mitigated that loss exponentially. And maybe she wanted it completely safe, right? So if we look at, as we structure this risk portfolio and include maybe some safe strategies, we've got CDs now that we offer clients that are FDIC insured, and we've got multi-year guarantee annuities for very competitive rates. We have index annuities to give you some of the upside of the stock market with none of the downside. And then we can use bonds, stocks, ETFs, mutual funds, some of those more traditional pieces. So, that's the advantage you get to working with, a fiduciary advisor. And I'm going to throw it out there that, being independent certainly helps us because we can look at the whole spectrum unbiased, because nobody is telling us, hey, we need to push this out here. We got a contest going, we need you to do this, or we got to, we'll send you over on a trip to do something like that. We get to avoid those conflicts of interest being the fiduciaries.
Well, again, if you would like to get your written game plan for retirement put together to address many of the greatest risks that you will face into and throughout retirement, to do a review and evaluation and analysis of current investments, accounts, and holdings, pick up the phone and give Chris McIntire a call, 800-868-1194. That's 800-868-1194. You can also be in touch by visiting McIntireRetirementServices.com, McIntireRetirementServices.com. Chris, you mentioned those CDs and then competitive rates. In fact, some of these rates are rather attractive on safer options that are now available, rates that we may not have seen really over the last decade or more.
Yeah. Hey, buddy, I'll tell you, I actually bought a CD for myself even. That's how competitive some of the rates are. And, we've been using 2 and 3 year multi-year guarantee annuities to take advantage of tax deferral as well, because if you're making 4% on a CD but you pay 20% in tax, right, you take 20% off of 4, you're netting 3.2. So sometimes tax deferral helps you get the real rate of return instead of the stated rate of return before taxes.
Those are things that Chris may not be completely understood by some who are making financial decisions. Now, the tax implications obviously have to be thought through with every piece of money that we choose to invest, that we earn, that we deposit, that we buy something with. Every dollar has a tax plan. But when we are making these kind of investment decisions, we've got to understand the full implications from a tax standpoint as well. That's another thing that we don't want to sort of just leave to luck or chance or do on a whim without understanding the consequences.
Yeah, correct. Roth IRA conversions, how much do you do it? What time of year do you do them in? Or do you do them at all, given everybody's certain tax situations? And again, conversions are different than contributions when it comes to that. That can have an impact on what your Medicare premiums are going to be. It can have an impact on the taxation issues of your Social Security benefit. And remember, at age 73 now, for folks that aren't 73 yet, that's when required minimum distributions start. So we do have a little bit more time, to do tax planning than we ever did, 3 years ago. When it used to be 70 and a half, it went to 72. Now it's 73. So we have a little bit more wiggle room in there to help, efficiently move assets throughout the portfolio, not just within the 401k or the IRA, but how do we get money out of that in the most tax efficient manner?
optimizing Social Security, minimizing taxes, and making sure that the investment portfolio aligns with your goals, your risk tolerance, your timeline. All of that is included in the planning process and in the written game plan for retirement plan that you can receive. No cost, no obligation, just for being a listener to this program. Give McIntire Retirement Services and Chris McIntire a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Or visit McIntyreRetirementServices.com. Chris, you're kind of a health nut, and we all want to live long, healthy lives. But if we eat one salad or go to the gym one time, we don't expect to be in shape, right? We do the habits, we do the routines, and then we make it to 85 in good shape. And we say, man, I'm lucky to have made it this far in good shape. And we'd be right. But we certainly did ourselves a favor by having those good habits and routines. It increased the odds and the likelihood that we would have that result, right?
Exactly. You know, there's a process to all of that. And, you know, it can take years. For example, you know, who wouldn't want to lose 15 pounds, right? Many of us would, right? You're not going to do that in a month. And Peter's got his hand up
Raising my hand over here. Yes, I am.
You know, but that's not going to happen in a 1 month time frame. That comes from, you know, long-term lifestyle changes. And I think, you know, many people realize, look, diets don't work, you know, long-term results. You know, if you're going to be in the stock market and want to deal with the ups and downs of it, that's a long-term proposition because it can behave very, you know, uncharacteristically, if you will. You know, we get the benefit of hindsight, you know, when you look back on things and say, hey, you know, hindsight being 2020, I should not have invested anything in the stock market. Okay. But the other part of that is if you were in stocks, reinvesting dividends, you bought more shares at lower prices, like in September of 2022 when the market took a dip. Whereas if you're sitting on the sideline, you miss all of that opportunity, that reinvestment process that is proven successful over the long haul. And yeah, there's going to be disappointing years. That's the nature of risk.
Chris, you mentioned that we don't know what the market will do and that there are years where it can have uncharacteristic downturns. Over time, you are a fan, you are a proponent, and you utilize the stock market to a great extent for clients. But we don't know what the behavior is going to be in any given year. It is a long-term proposition. You are not against the market in any way. It's simply that timing the market is inherently difficult, if not impossible. And yet, Chris, I'm curious as to why the financial industry still promotes us to base our timing of retirement on the fact that we will know what the outcome will be. It seems to me to be inherently self-conflicting that we can't time the market, but we leave things up to chance in timing our retirement.
Yeah, that's a good perspective there. And, you know, we help a lot of people when they turn 59 and a half because they can get money from their 401k and roll it over into an IRA, even if they're going to continue to work to say 65 when they can get on Medicare and, you know, make health insurance more affordable in their retirement. So we help them typically de-risk.
Is that a big piece of the process, Chris, is beginning this process a little early in advance and beginning to transition rather than an abrupt change to retirement?
Yeah, no question about it. And, you know, wherever the stock market is, you know, I mean, we do that planning process, you know, very diligently because, you know, hey, the stock market was up this year. Okay. All right. But where's it going to be a year from now? You know, people get greedy and they want to stay in there a little bit longer and then it dips. And then they say, well, I'm going to wait until it gets back to where it was before. And then I'll make some changes, you know, so you've got to help, you know, I think sometimes we help coach people on, you know, look, here's what's going to happen throughout the course of your retirement. We just don't know. Not everybody knows that exact date. If we knew when we were all going to pass away, we'd know what year to take Social Security, right?
Right.
And, you know, and I'll say, you know, Warren Buffett didn't get rich by, you know, buying CDs. He buys stocks and he buys, companies that are well run and at the right prices. So, he's been a student of the market as well. We're all not Warren Buffett, so we need to have some safe strategies in there as well, and create a diversified portfolio of stocks, bonds, ETFs, all those different pieces, annuities for income, annuities for safety, CDs for safety, liquid cash, life insurance to help cover, some of the unknowns out there. So it's not an easy 60-40 portfolio and let it run. There are a lot of different things that can happen. Last year was the worst year, 2022, in history for a 60-40 portfolio.
Different tools available to us for different reasons and different purposes. And that's why you've got to align those with your specific goals through the planning process, ladies and gentlemen. And that's what Chris McIntire and McIntire Retirement Services provide for their clients. If you would like to get that plan put together, look at all of the different aspects in planning, the risks that we are exposed to in retirement, and optimize your portfolio and your outcome, pick up the phone and give Chris McIntire a call, 800-868-1194. That's 800-868-1194. And I'm sure Warren Buffett wouldn't like it, Chris. And in fact, he's got a couple rules. Number 1, don't lose money. Rule number 2, refer to rule number 1. But I think that Warren Buffett probably could survive a pretty significant loss, 25, 40, 50% loss in the market. Warren Buffett would be okay. Most Main Street Americans, that same kind of market downturn might completely alter our trajectory and lifestyle, which is why we need to consider some of the alternatives as we are making that transition to retirement.
Yeah, that's a good perspective. And, in Berkshire Hathaway, Warren Buffett's company had a very disappointing year in 2022, so, even the best, nobody bats 1,000. But, he's got a long, perspective in knowing, as long as he has been investing, if you look how old Warren is, he's been around a while, been through a couple of world wars and, some major conflicts and, some economic calamities, and, still a lot of people look up to him for his vision. And that's what, experience brings that wisdom with you, right? There's a lot of smart people out there, but you need experience to get wisdom.
Chris, there are a couple of risks that are specific to retirement that we don't really experience during our working career, and therefore may not have heard of them or planned to address them. But can you discuss with us sequence risk and withdrawal rate risk, what those mean, and why we need to specifically have conversations and then formulate plans to address them?
Sequence risk, it is very important. That is something that we deal with. Like 2022 was a good example because the stock market fell, let's say 20%, using a round number. The bond market fell 15%. So if you just retired in 2022 and, your first sequence of returns ended up being a negative 15, hey, that's going to have a pretty big impact on your portfolio over time. Especially it's a lot different than if the market went up 15% versus down, and again, I'm also assuming you're pulling money out of your portfolio. So if you pulled out 4% of your nest egg and the portfolio was down 15, that's a 19% hit to the nest egg. And it takes a while for that to recover, obviously. So, we don't want, that's why you have a different alternative in case the sequence of returns begins unfavorably for you. You said, hey, okay, well, I got a different strategy. I'm going to use that and let my other strategy recover. So a plan A, plan B type conversation.
Chris, in addition to wanting your clients and proactive savers and investors across Northwestern Ohio and really anywhere, not to simply rely on luck and chance, but to actually formulate and have a plan in place, you have also identified some common financial myths or misconceptions that many financial plans and projections are based on that you encourage people to question. And so if we could, for the last little portion of the program, going through a few of those financial myths, the myth that the market always goes up or that we can count on an average 10% rate of return.
Yeah, or I can rely on my investments to provide my income forever. That's not necessarily the case. I got a couple of them here. Taxes will be lower in retirement. Okay? I don't know where that's written in stone anywhere. I mean, tax rates are at historical lows right now. We hear all the talk about the deficit. Okay, taxes could certainly go up for many folks. Inflation will not impact my retirement. Okay, I think that narrative has changed very significantly just in the last, let's call it 18 months, if you will. Okay. I'm not going to need any life insurance in retirement. I've got all my debts paid off. Okay. Well, that may be the case for some folks because, they've replaced what life insurance had a need for, but, a lot of folks will still have that depending on how they took pensions and whatnot. Okay. Capturing the match on my 401k will be enough to retire. You don't know what that is. That's not contractually guaranteed anywhere on how much income that's going to make for you. And I would always caution people, hey, what got you to retirement isn't necessarily what's going to get you through retirement.
Chris, I sort of take issue with that and have a problem with the way that many 401k statements sort of project out the amount of income they'll generate for us in retirement. And they make it seem like, oh, you're going to have this many thousands of dollars a month with the 401k, when that is anything but reliable and often includes outside sources of income like Social Security in the equation. People, I think, look at that number and think, well, I'm on track, I'll be all right. And then unfortunately have a surprise that they can't really make up from as they enter into retirement.
Yeah. And I it could be part of the law of unintended consequences that, I think it was Congress passed some legislation to say, hey, 401k statements need to include an approximate amount of income that dollar amount will generate. That way workers have a chance to say, hey, I got $300,000 in here. Here's how much I can expect over my retirement. I think the intention was good, but maybe it needs some revisions there. And, instead of being a footnote, maybe it needs to be in, bold-faced type that, hey, this isn't contractually guaranteed. And, here's the assumptions we're utilizing. And, maybe some of those things aren't nearly as realistic as what certain compliance regulations probably should mandate.
Yeah, well, a couple more you have, Chris. Target date funds are set it and forget it. Dividend stocks are reliable for income. Social Security will be enough to live on. Medicare will cover my healthcare costs. All myths and misconceptions, ladies and gentlemen, and you need to carefully examine whether or not your plan, your financial future, is reliant on any of these. Let's remove the luck and chance out of the equation. Let's plan proactively to help to make sure we work forward, make progress toward our financial goals. That's what the plan, that's what the planning process, that's what addressing these risks is all about, removing the variables that can impact our financial future or controlling and minimizing them where possible. Conversations that Chris McIntire has each and every day there at McIntire Retirement Services. And he's made the offer to put together for you your game plan for retirement, a specific individual custom written plan for your financial investment and retirement future. Pick up the phone to take advantage. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, it is always a pleasure, sir. I do appreciate your perspective, guidance, the time that you provide here on the program, and always being the resource for proactive savers and investors in and across Northwestern Ohio.
Hey, thanks, Peter. My pleasure, everybody. Have a nice weekend. Stay safe out there. Thank you for listening.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.